Mastering the basics of income recognition. Imagine you're a financial detective, sifting through a company's books, searching for clues that reveal its true financial health. One clue stands out above all: income. It's the heartbeat of any business, the lifeblood that sustains its growth. But understanding when and how to recognize this income is where the real detective work begins. This process, known as income recognition, is a fundamental accounting principle that dictates when income should be reported. Mastering it is akin to cracking the code of financial transparency and integrity. In this video, we'll unravel the mystery of income recognition, taking you on a journey through its core principles, methods, impacts on financial reporting, and much more. So, grab your magnifying glass and detective hat, and let's get started. Understanding the concept of income recognition. Income recognition, at its core, is an accounting principle that determines the specific conditions under which income becomes realized as revenue. It's a method for deciding when an economic benefit gained by a business gets reflected on its books. But before we delve deeper, it's crucial to distinguish between revenue and income, two terms often used interchangeably but have distinct meanings. Revenue refers to the total money received from a particular activity or source. Income, on the other hand, is what's left of the revenue after deducting expenses. Essentially, revenue is the total earnings, while income is the profit. To illustrate, let's consider a real-world example. Imagine a bookstore sells a book for $20. The $20 is revenue as it is the total amount earned from the sale. But, to determine income, the bookstore needs to subtract the cost it took to acquire the book. If the bookstore bought the book for $15, the income, or profit, from this sale would be $5, $20-$15. Key principles of income recognition. In the world of accounting, two principles govern income recognition: the revenue recognition principle and the expense recognition principle. The revenue recognition principle states that revenue should be recognized when a business has completed the earnings process and there are reasonable assurances about the collection of the payment. For instance, in our bookstore example, revenue would be recognized when the book has been sold, the earnings process completed, and it's reasonably certain that the customer will pay for the book. On the other hand, the expense recognition principle, often referred to as the matching principle, insists that expenses should be recognized in the same period as the revenues they help generate. If the bookstore pays $500 per month to rent its storefront, this expense should be recognized in the same month that it earns revenue from selling books. Understanding the relationship between revenue and expense recognition is fundamental to grasp income recognition fully. Together, these principles ensure that a company's financial statements accurately reflect its performance and financial position, ultimately leading to better financial decision-making. Income recognition methods. In the grand theater of accounting, two primary methods dictate the act of income recognition: the cash basis method and the accrual basis method. Under the cash basis method, income is recognized when cash is received, and expenses are recognized when they are paid. This method is like a straightforward financial diary that chronicles the cash inflows and outflows. For instance, if our bookstore sells a book in January but doesn't receive payment until February, the income is recognized in February. Contrarily, the accrual basis method records income when it is earned and expenses when they are incurred, regardless of when cash changes hands. Using this method, if the bookstore sells a book in January and receives payment in February, the income is recognized in January, when the book was sold. Both methods have their pros and cons. The cash basis method is simpler and provides a clear picture of cash flow, making it suitable for small businesses. However, it may not accurately reflect a company's long-term financial health as it doesn't account for receivables and payables. The accrual method, though more complex, gives a more accurate financial picture over longer periods, especially for businesses with significant receivables and payables. Its downside is that it can obscure short-term cash flow, which can be problematic for businesses with tight cash situations. Income recognition and financial reporting. Income recognition plays a pivotal role in shaping a company's financial statements, impacting everything from the balance sheet to the income statement and statement of cash flows. Its accuracy is paramount in providing a transparent depiction of a company's financial health. In financial analysis and decision-making, income recognition helps to estimate a company's profitability, solvency, and liquidity, three vital attributes that investors and creditors scrutinize. For instance, recognizing income prematurely may inflate profits temporarily, but when the financial reality catches up, it could lead to a decrease in the company's perceived value and credibility. This brings us to the importance of accurate income recognition in maintaining investor and creditor trust. Misstated income, whether due to error or fraud, can lead to mistrust, stock price decline, or even regulatory penalties, as financial stakeholders rely heavily on the accuracy of financial statements. Regulatory guidelines on income recognition. Income recognition is not a free-for-all. It's bound by regulatory guidelines to maintain consistency, reliability, and comparability in financial reporting. The two key players in setting these rules are the Generally Accepted Accounting Principles, GAAP, in the U.S. and the International Financial Reporting Standards, IFRS, for international businesses. Both GAAP and IFRS provide guidelines on when and how income should be recognized. For instance, the GAAP's revenue recognition principle stipulates that income should be recognized when it is realized or realizable, and earned. The IFRS, on the other hand, focuses on the transfer of risks and rewards as a criterion for income recognition. Noncompliance with these standards can lead to dire consequences, including restatement of financials, regulatory scrutiny, loss of investor confidence, and potential legal ramifications. Hence, mastering the principles and methods of income recognition in line with these guidelines is not just a business necessity, it's a mandate for financial integrity. Common challenges and mistakes in income recognition. Even with well-laid rules and regulations, income recognition can sometimes feel like navigating through a maze. Certain complexities and potential pitfalls might lead businesses to make errors, affecting their financial reporting and subsequent decision-making. One common mistake is prematurely recognizing revenue. Suppose our bookstore records income as soon as a customer places an order, even before the book is delivered. This hastiness might inflate the company's earnings in the short term but could lead to inaccuracies once the customer pays or, worse, cancels the order. Another pitfall is not recognizing income at all or recognizing it in the wrong period. If the bookstore fails to record a sale, or records it in a different accounting period, it can lead to misstated financial statements. For instance, Groupon, the e-commerce marketplace, faced a significant setback in 2011 due to a misinterpretation of income recognition rules. They initially reported revenue as the gross amount they billed customers, which inflated their revenues. Upon review, they had to restate their financials, showing only the net amount they received as revenue, leading to a massive drop in their reported income. So, how can these mistakes be avoided? A robust internal control system is essential. Regular auditing and review of financial statements, thorough knowledge of income recognition rules, and timely adjustment of entries can help ensure accurate income recognition. In conclusion, like the decoder ring to a secret message, mastering income recognition is critical to revealing the true financial narrative of a business. Its principles, if properly applied, help in painting an accurate picture of a company's financial health, essential for sound decision-making. The complexities of income recognition might seem daunting initially. However, with a keen understanding of its rules and practices, businesses can turn this complexity into a valuable tool for financial transparency and integrity. As we bid adieu to this exploration of income recognition, we encourage you to delve further into this fascinating subject. Remember, in the realm of finance and accounting, knowledge is not just power, it's profit. Thanks for watching.